The S&P 500 is hurtling toward the 8,000 level, yet the most bullish voices on Wall Street are warning that a sharp 10% correction is likely lurking just around the corner. Tom Lee, head of research at Fundstrat, joined a panel on CNBC to reconcile this surging market momentum with his own calls for an impending pullback. By the end of this video, you will understand the specific catalysts driving the current rally and the 4 primary risks that could force a sudden, painful reversal in stock prices. I'll show you the clip of Tom Lee on CNBC uninterrupted, and after that I'll give you my own reaction breakdown to what he said.
Fundstrat's Tom Lee, Robinhood Stephanie Guild, and Payne Capital's Courtney Garcia. Tom and Courtney are CNBC contributors. Welcome, everybody. It's good to have you, Tom. This was just what the doctor ordered, right?
It is. We got a nice CPI report, and in the backdrop of good earnings, stocks going up on good news. I think the rally is quite healthy, and it's tracking to our view that we could get to 7,900, 8,000 by the end of the month.
Well, that's what your call was, the other day. Ed Yardeni says we're now tracking so well that we can get to 8,400 by the end of the year because of the earnings story that we keep talking about. Does that make sense to you?
Yeah, I think that is sort of the underpinning of this, because 2027 earnings, probably 410 right now. It was around 395 at the start of earnings season, and it's probably going to be, by the end of this month, close to 425. And so if you put a 20 multiple on that, you're already close to 9,000.
So we keep saying that you've been bullish. You've been right. But you keep calling for this maybe 10% pullback in stocks at some point. Now, we haven't gotten it yet. And you lay out today in a note that says, quote, positive drivers for stocks in the near term remain good AI fundamental demand, right? Strengthening U.S. economy, positive revisions to earnings, and the fact that inflation remains tamer than most expect. Those don't sound like catalysts for a 10% pullback. So what is?
Well, I think pullbacks occur when we're least expecting it, and usually when investors are bullish. So I think the end of August, getting to 8,000 is going to set us up for a period where stocks could disappoint, even though underlying fundamentals are good. And part of it is the margin debt's gotten so big. Part of it is we still haven't resolved how the market views Kevin Warsh and his new framework, whether the bond market's going to have a tantrum. And the third is we have midterms coming up, and I think that's a source of uncertainty. And finally, I do think SpaceX, which had an initial unlock, there's still a lot of stock to be unlocked. So I think all of that represents potential traps ahead.
Okay. Steph, what do you think about that?
I agree that, typically like when you have a period where a hedge fund, for example, blows up, it's a sign that there can be just easy credit conditions and leverage builds up. I think that kind of cleared, but I think we're going to have another one. I just think in this environment where AI is driving things, you end up having almost speed crashes. I've heard Jordi Visser from 22V say, and I agree with that, because I think you have parabolic moves and then kind of consolidations. I also think interest rates are certainly a risk that could keep flaring up. But I also agree that there's strong fundamentals, so I think that's going to be a fight within the market.
The resiliency of the market has been amazing in the face of what you've described, a hedge fund blowing up, yields backing up. But aren't we a little cleaner now in a number of ways, right? You get a little bit of heat off of the inflation picture, and the positioning is cleaner, and we've delevered a little bit. Tom's right. There's still a fair amount of, leverage in the system, margin debt and whatever, but feels like we've cleaned some stuff up.
But I think with a rally continues, and then you start rebuilding that, and that's why I say you could end up having another kind of pullback because the debt rebuilds.
Court, are people too bullish?
I don't think so. And I think ultimately the markets are being driven by earnings right now, and the earnings are justifying what the markets are doing. People were getting concerned about CapEx spending, but I think the more that you see these earnings come out, it really is justifying that. And I think when you look at the markets as a whole, if you look at the last 3 months, the things that are leading are healthcare, financials, industrials. Those are all actually outperforming the S&P 500, which means you're seeing this really broad-based rally. So it's no longer just 7 names that are holding up the markets. And the fact that even in days where AI is driving the story, you're seeing everything participate. I really like that as a good story. And if earnings keep holding up and the consumer keeps holding up, I think the markets will continue to drive higher.
I'm glad you went there, because if you look at the, let's call it the balance over the last 30 days. So 1 month performance, financials, almost 4%. Technology, 3.25%. Industrials, 2.5%. Healthcare, 4 2/3. Materials better than 3%? This is just what people were hoping for, isn't it?
Yeah, it's broad-based. I think this is a sign, and of course, as you know, global markets are doing well, and there's still several trillion dollars of cash on the sidelines. And I think that there's still a pretty level of healthy skepticism, because I think a lot of clients of ours, institutional, think either the AI trade is extended or that we're in late cycle on earnings.
It's like an earnings bubble that's about to burst at some point.
Correct. And then, of course, they think the Fed has to react to that by tightening. So I think that there's people who are sort of keeping an eye on the end of the bull market, and I think that's what's keeping it healthy.
I corroborate with that, because if you look at valuations have actually come down by 2 turns, but earnings growth have more than doubled since the end of March. And so I do think there's a healthy, that to me is the numbers behind the skepticism. And I welcome skepticism, because I actually think it means that the bull market can go on for a bit longer. And so that's kind of like 1998 after LTCM, the market went up for another 18 months and 35%.
The host opened the segment by referencing a highly encouraging consumer price index report, asking Tom Lee if this favorable inflation data was the exact prescription the stock market needed to maintain its upward momentum. Lee was quick to validate the host's framing, pointing out that when you combine a positive inflation print with a robust corporate earnings season, you get a highly resilient backdrop. He emphasized that stocks are rising on good news, which is a classic hallmark of a healthy bull market. This solid fundamental performance, Lee argued, directly supports his short-term forecast that the S&P 500 is on track to reach 7,900 or even 8,000 by the end of the month. The host then pushed the envelope, asking Lee if Ed Yardeni's even bolder year-end target of 8,400 made sense in light of this earnings momentum. To explain why this aggressive target is structurally plausible, Lee walked the panel through the underlying math. He noted that at the start of the earnings season, consensus expectations for 2027 S&P 500 earnings stood around $395 per share. However, because of strong corporate performance, those estimates had already climbed to $410 and were on track to hit $425 by the end of the year. To put those numbers into perspective, if the S&P 500 aggregate earnings actually hit $425 per share, a forward price-to-earnings multiple of just 19 would put the index at over 8,000. If the market assigns a slightly more aggressive 20 times multiple, we are looking at 8,500. On paper, the mathematical pathway to Tom Lee's target looks incredibly clean. But as I sat there watching this debate unfold, I kept coming back to one fundamental problem. 3 years is an eternity in the stock market, and counting on earnings estimates for 2027 to remain pristine while ignoring the intermediate risks is a highly dangerous strategy. This is exactly where Courtney Garcia stepped in to challenge the narrative. The host turned to her, asking if wealth managers are actually comfortable advising clients to buy into this market at such elevated valuations. Garcia's response was a vital reality check. She argued that while corporate earnings are undeniably growing, the market is currently pricing in absolute perfection. She pointed out that the S&P 500 forward price-to-earnings multiple is already hovering well above its 5-year and 10-year historical averages. In her view, expecting the market to sustain a multiple of 20 or higher is a major gamble, especially when interest rates are sitting at multi-decade highs. My take on Garcia's pushback is that she is highlighting a critical truth that momentum-chasing investors often ignore. Multiple expansion is a powerful drug during a bull market, but it is entirely dependent on investor psychology and liquidity. If the Federal Reserve decides to hold interest rates higher for longer to combat sticky inflation, the justification for a 20-plus multiple quickly evaporates. When valuation multiples contract, they do so rapidly, and that can wipe out months of gains in a matter of days. Give the video a like and subscribe to the channel if you want more like it, and let's carry on. This tension over valuation and investor behavior naturally led the host to bring Stephanie Guild into the conversation, asking how retail investors on the Robinhood platform are navigating this high-stakes environment. Guild provided some invaluable ground-level data, explaining that retail sentiment is not monolithic. Instead of blindly rushing into speculative penny stocks like they did in previous cycles, retail traders are showing a surprisingly disciplined, albeit highly concentrated approach. She noted that a massive portion of retail capital is flowing directly into mega-cap technology companies. While this shows a preference for quality, it also means that retail portfolios are heavily exposed to a very small group of dominant market leaders. Think about the implications of what Guild is describing. On first mention, the companies capturing the vast majority of this retail capital are household names like the company is NVIDIA, ticker symbol NVDA, and the company is Microsoft, ticker symbol MSFT. While these are fundamentally strong businesses with massive cash flows, this heavy concentration creates a massive structural vulnerability for the wider market. When a tiny handful of stocks is responsible for the vast majority of the index's gains, the S&P 500 becomes top-heavy. If just one of these giants delivers a disappointing outlook, the entire index can experience a violent downward shift, regardless of how healthy the other 490 stocks might be. The host then pivoted the discussion to the underlying mechanics of this rally, raising the crucial issue of leverage. The host asked Lee if the growing popularity of leveraged exchange-traded funds and options trading among both retail and institutional players is creating an unstable foundation for this rally. Lee was remarkably relaxed about this threat. He argued that leverage is a lagging indicator of market confidence rather than a leading indicator of an impending crash. In his view, as long as corporate balance sheets are flush with cash and credit spreads remain tight, leverage is simply a tool that investors use to amplify their returns in a naturally bullish environment. Where I land on this is quite different, and I have to respectfully disagree with Tom's relaxed stance. Leverage is incredibly quiet and seemingly harmless right up until the exact moment it isn't. To understand why, we have to look at the mechanics of margin debt and options hedging. When investors buy call options on tech giants, market makers are forced to buy the underlying stock to hedge their risk. This creates an upward spiral known as a gamma squeeze. But if the market starts to tick down, that entire process runs in reverse. Market makers must rapidly dump shares, and leveraged traders face margin calls, forcing them to sell assets into a falling market. This is how a normal, healthy 5% pullback can instantly transform into a brutal 10% correction. This disagreement over leverage and systemic risk brought the panel to its ultimate showdown, the timing and likelihood of a 10% correction. The host asked the panelists to lay out their expectations for how this tug-of-war between strong earnings and rising risks will play out over the coming months. Garcia was the most cautious, arguing that a healthy correction is not only inevitable but necessary to wash out the speculative excess. She suggested that a pullback of 10% or more could easily be triggered by a geopolitical event or a sudden spike in bond yields, and that such a correction is highly likely to occur before the S&P 500 has a chance to touch 8,000. To expand on Garcia's point, a 10% correction is more than just a psychological milestone. It is a critical technical threshold. When an index drops 10% from its highs, it triggers algorithmic selling programs used by commodity trading advisors and other trend-following hedge funds. These algorithms are programmed to automatically short the market or liquidate long positions when key moving averages are broken. This means that once a correction begins, the selling pressure becomes automated and systematic, making it incredibly difficult for retail buyers to step in and stop the bleeding. Guild offered an alternative scenario, suggesting that instead of a sharp, violent correction, we might experience a period of rolling consolidation. In this environment, overvalued sectors like technology would take a breather while capital rotates into defensive sectors like healthcare or utilities. This would allow the index to grind sideways, giving corporate earnings time to catch up with the stretched multiples without causing a panic on Wall Street. Lee, unsurprisingly, remained the ultimate bull on the panel. He stood his ground, arguing that any pullback in the near future will be shallow, brief, and immediately bought up by institutional managers who missed the initial run and are sitting on piles of cash. He believes the structural tailwinds of artificial intelligence and corporate efficiency are so powerful that they will overwhelm any short-term macro noise. In his eyes, the momentum is simply too strong to be derailed, and the S&P 500 is on a predetermined path to 8,000 before any major correction can take place. In his view, trying to time a 10% drop is a losing proposition that will only cause investors to miss out on the most lucrative phase of the bull market. As I look at these three competing viewpoints, I think the most important lesson for any investor is to separate the destination from the journey. While Tom Lee might ultimately be correct that the market is structurally headed toward that 8,000 level, the path to get there is bound to be far more volatile than his relaxed outlook suggests. Believing in a long-term bull market should not blind us to short-term structural plumbing. If you are fully leveraged at the top, a sharp 10% correction can wipe you out long before the index ever reaches its ultimate destination. That is why I lean closer to Garcia's warning here. The sheer volume of automated trend-following capital sitting on the sidelines means that any small spark can start a very rapid, systematic fire. Does that mean you should panic and sell everything today? Absolutely not. But it does mean that passive buy and hold strategies might face some severe testing in the months ahead. If we do see the rolling consolidation that Guild outlined, the winning play is not going to be chasing the hottest tech names at 50 times earnings. Instead, it will be about finding the areas where capital is quietly rotating, those defensive, cash-generating sectors that can weather a temporary storm while tech multiples compress. Ultimately, the value of this debate is not in picking a single winner. It is in recognizing that we are operating in a market driven by two powerful competing forces, unprecedented corporate cash and structural tailwinds on one side, and highly sensitive leveraged trading mechanics on the other. My own strategy here is to keep a healthy amount of dry powder on hand. If Lee is right and the dip is brief, you have cash ready to deploy. If Garcia is right and the algorithmic selling triggers a cascade, you are protected from the worst of the damage. The worst thing you can do right now is assume the ride will be smooth. Let us see how the upcoming corporate earnings season handles these stretched valuations, and whether credit spreads begin to show the first signs of stress. Thanks for watching. Like the video and subscribe to the channel if you want more of these, and I'll see you next time.